Have you ever wondered how people make money by trading currencies? How can the simple act of exchanging one currency for another turn into profit? Imagine this. Every day, over $6 trillion is traded on the Forex market, the largest financial market in the world. But unlike stocks or bonds, it's not a place you can walk into. It's global, decentralized, and operates 24/5. You can trade from anywhere, at any time, as long as you know how to navigate it. So, what exactly is Forex trading, and how does it work? That's exactly what we're going to uncover today.
Understanding Forex trading, the basics. Let's start with the most fundamental question. What is Forex trading? Forex, short for foreign exchange, refers to the global market where currencies are bought and sold. Unlike the stock market, where you buy shares of companies, in Forex, you trade currencies. Essentially, when you engage in Forex trading, you're betting on the value of one currency relative to another. If you think a currency will rise in value, you buy it. If you think it will fall, you sell it. For example, if you buy the EUR-USD currency pair, you're buying the euro and selling the US dollar. Your profit or loss will depend on how the exchange rate between those two currencies moves. The Forex market, a 24/5 marketplace. One thing that makes Forex different from other financial markets is that it's open 24 hours a day, 5 days a week. The market doesn't sleep, and neither do the opportunities. But why is that the case? Forex trading is conducted electronically over the counter, OTC, meaning it's not centralized on one exchange like the stock market. Instead, trading happens through a network of banks, brokers, dealers, and even governments around the world. This decentralized nature allows Forex to stay open across different time zones, from 5 p.m. Sunday to 5 p.m. Friday, Eastern Time. This continuous, round-the-clock trading means that no matter where you are, there's always a chance to jump into the market and start trading.
Currency pairs, the core of Forex. Now, let's talk about currency pairs. In Forex, currencies are always quoted in pairs. You never trade a currency in isolation. Instead, you trade one currency against another. For example, EUR-USD means you're trading the euro against the US dollar. The first currency in the pair is called the base currency, and the second one is called the quote currency. The price of a currency pair tells you how much of the quote currency you need to buy one unit of the base currency. So if the EUR-USD pair is priced at 1.1300, it means that for every 1 euro, you would need 1.13 US dollars. Now, why does this matter? Well, as you trade, you're not just hoping that one currency will go up or down. You're betting on the relative movement between two currencies. If you believe the euro will gain strength against the dollar, you'll buy EURUSD. If you think the euro will lose value, you'll sell it. Pips, the smallest price movements. When it comes to measuring how far a currency has moved, we use something called a pip. A pip stands for percentage in point, or sometimes price interest point, and it represents the smallest movement a currency pair can make in the market. For most currency pairs, 1 pip is equivalent to 0.0001, or 1/100th of a percent. So, if the EUR-USD moves from 1.1300 to 1.1301, it has moved 1 pip. Why is this important? Well, it helps you measure your profits and losses. For example, if you buy EUR-USD at 1.1300 and it rises to 1.1350, you've made 50 pips in profit. Knowing how pips work is essential in understanding how much you stand to gain or lose from a trade. Lot size, the volume of your trade. In Forex trading, you don't just trade in units of one, you trade in lot sizes. A standard lot represents 100,000 units of the base currency. This means if you're trading one standard lot of your USD, you're effectively buying or selling 100,000 euros. There are also smaller lot sizes, called mini lots, 10,000 units, micro lots, 1,000 units, and nano lots, 100 units. These smaller lot sizes allow traders to start with smaller amounts of capital, making Forex trading more accessible to a wide range of people. But here's the thing, while trading smaller lots reduces your exposure, it also reduces the potential profit or loss you can make per pip. So, if you're just getting started, using mini or micro lots might be a safer choice as you learn how the market works. Leverage, amplifying your trades. Now, let's talk about a key element in Forex trading that can be both powerful and risky. Leverage. Leverage allows you to control a larger position than what you could with your initial capital. For instance, if you have $1,000 and your broker offers 101 leverage, you could control a position worth $100,000. Essentially, leverage magnifies your buying power. While leverage can lead to greater profits, It can also lead to significant losses if the market moves against you. Imagine you're trading with high leverage and the market goes in the opposite direction. You could lose more than your initial investment, and you could be forced to close your position early to limit your losses. It's important to use leverage cautiously and ensure that you have a solid risk management strategy in place. Bid, ask price, and spread. The cost of trading. Every Forex trade involves two prices, the bid and the ask price. The bid price is the price at which you can sell a currency pair, and the ask price is the price at which you can buy it. The difference between the two is called the spread. For example, if the EUR/USD bid price is 1.1300 and the ask price is 1.1305, the spread is 5 pips. The spread is essentially the cost of making a trade, and it's how brokers make money on each transaction. Typically, major currency pairs like EUR/USD, GBP/USD, USD/JPY have a tighter spread, which means it's cheaper to trade them. Less liquid currency pairs or exotic currencies tend to have wider spreads, which means higher costs for traders. Volatility and risk. Understanding market movements. One of the biggest factors affecting Forex prices is market volatility. Volatility refers to the degree of price movement in the market. When the market is highly volatile, prices can swing dramatically in a short period of time. This presents both opportunities and risks. High volatility means there's potential for larger profits, but it also comes with a higher level of risk. Low volatility, on the other hand, means the market is calmer, with smaller price movements, leading to less risk, but also less reward. Factors that can affect volatility include economic data releases, political events, natural disasters, and changes in interest rates. Keeping an eye on these factors can help you anticipate price movements and adjust your trading strategy accordingly. So, how does Forex trading work? In a nutshell, Forex is the market where currencies are bought and sold in pairs, with prices moving based on various economic, political, and social factors. By understanding the basic concepts, currency pairs, pips, lot sizes, leverage, spreads, and volatility, you can start to navigate this exciting and fast-paced market. But remember, Forex trading isn't a get-rich-quick scheme. It requires practice, patience, and a solid understanding of how the market functions. If you're just starting out, it's important to focus on learning the basics first. As you gain experience, you can start exploring advanced strategies and techniques. We hope this video gave you a solid foundation for understanding the basics of Forex trading. If you're ready to dive deeper, don't forget to grab the free Forex trading guide linked in the description below. It's the perfect next step to kickstart your trading journey. What do you think? Is Forex something you'd be interested in trying? Drop a comment below and let us know your thoughts or questions. And make sure to hit the like button, subscribe, and stay tuned for more in-depth lessons on Forex trading.
Now that you've got the basics down, you're ready to take the next steps toward becoming a successful Forex trader. With the right tools and mindset, Forex can offer exciting opportunities. Remember, it's all about understanding the market, managing your risk, and staying disciplined. Keep learning, stay curious, and watch your trading knowledge grow.